And let me also have the pleasure of hosting today's guest, and he's an expert in this field. And Nikunj Sinha, who is Senior Vice President Financial Markets at IDFC First, is going to be delivering this wonderful lecture to all of us. And he comes with a PGDM from TAPNI, the prestigious TAPNI, when he has completed between 2004 and 2006. And all he has done is the company secretaryship from ICSA between 2012 and 2014. And he began his career as a manager at ICSA Bank between June 2006 and May 2007. And next, he went on to work for HDFC Bank as a manager between May 2007 and March 2009 for almost about 2 years' time in New Delhi. And then he grew up. He got a promotion as a senior manager at HDFC Bank between 2009 and March 2011, almost for 1 year, 2 months there, again in New Delhi. And after that, he became an AVP for Treasury Sales at Kotak Mahindra between April 2011 and August 2015, where he was there for a quite longer time, that is for almost 4 years and 5 months. After which, he has been there at IDFC First. And he began his journey with IDFC as Associate Director on August 2015 and almost till June 2018 in Delhi. And then on a promotion, he became regional head for South for the financial markets in Bangalore, and he has worked for this illustrious bank. As you would know, IDFC is one of the new age banks that is the amalgamation of two very great institutions, IDFC Bank and Capital First. And all the great stories that come out of its founder CEO, Mr. Vaidyanathan, and more importantly, the kind of contribution that he has been making, or the kind of I would say selfless work that he is doing for his workers. I think the latest one is what I know almost all of you must have heard about. The kind of the shares that he had, in almost 9 lakh shares, he just donated for 5 of his workers. No relationship whatsoever, worth almost about 4.3 crores. And that speaks largely about the kind of culture that he and his team, I'm sure, Nikunj also is a part of it, and they're trying to build in this, financial services industry. And Nikunj, apart from all this, is also an experienced financial market professional with a demonstrated history in Indian banking industry. And also, he's an expert, I would say, in he's very skilled in forex, fundraising and structuring, and also forex risk management, which is very, very rare and also very high intense area as far as finance is concerned. So welcome, Nikunj, and over to you and for your presentation. Look forward to your presentation. And what we'll do is we will have the questions from all the participants, put them in the Q&A, and I will, with your permission, I'll once your session gets over, I will relay them to you so that you can respond to them towards your presentation.
Sure, Doctor.
Thank you so much.
Sure, Dr. Nagendra. I'll just share my presentation.
Thanks.
And if one can confirm whether it is visible.
Yeah, I can see it. I can see everything. Go to the first slide. Yeah.
No, so thank you so much, and very good evening to everyone here, and thanks for TSW for hosting me here. I would say that Dr. Nagendra has been very generous in giving an introduction for me, but if I were to take this liberty, I'll say little excess of a decade and a half of being a banker. Maybe what's not there on the LinkedIn and my CV perhaps is that I've worked in all 4 parts of the country. I mean, starting from Calcutta to Pune to Bombay, Delhi, and this FinTech as a buzzword is a thing which has started in 2018 when I came down south in the IT city, or capital IT city of the country, which is Bangalore. And here I am sharing with you this wonderful topic. My thoughts around it is technology eating finance, right? And let me just start with a couple of disclaimers here. Well, definitely finance is something which I have worked deeply across financial markets has been a career banker. But of course, the entrenchment into technology part of it, and so to say, the fintech word is something which I'm also a learner, maybe in past 4 to 5 years, and therefore, what I am going to present to you will have a tinge of a banker's perspective of how technology is, annexing the turf which earlier the incumbents like a bank or a NBFC, etc., used to hold. So, with that disclaimer, let me just start. And apologies in case there is too much of bank around it, right? But I think that comes very near to my heart, and therefore I'll be able to share it with you with much more passion and depth, right? So let's start with it. I would start with this presentation first slide and maybe just spend 10 seconds on this. This is by a gentleman we all know, founder of Alibaba and Alipay, I would say, where in year 2015, he met up with the CEO of Walmart and he had a bet with him. He said, look, gentlemen, 10,000 new customers, if Walmart was to acquire, right, you will have to issue a draft plan of establishing a new warehouse, systems, people, logistics, OR, whatnot. And frankly, for me, the next 10,000 customers require just two servers. Now, that's a very strong statement which technology makes to finance and the incumbents who are operating in the finance industry. And broadly, that's the narrative which I wanted to present to all present here. Uh, the broad flow of the presentation, if you ask me, is there are three pillars to the discussion that I will have. Is first to maybe quickly have a look at the cost of repetition, that what does a fintech technically qualify as? Is there a difference between a fintech and a tech fin? And who are they entering into a fist fight against? Who are those incumbents? That will be the first part of it. Second is what are the trends globally, as well as a little more in depth in India. The fintechs have definitely attempted to disrupt what was earlier a clear turf of incumbents like banks, PSUs, private lenders, NBFCs, gold loan, equipment finance companies, etc. And as we say that, just wanted to also observe and articulate to you that what is it that they have attempted to disrupt? Is it the organizational structure, or is it the way that the finance has been delivered to the last mile consumer that has been disrupted, right? So that sets the theme whether fintech indeed is eating, finance. And the last and the third is essentially the challenges or perhaps the question marks, which the very many experts in developed nations have put across. And more importantly, to each country its own, the regulator has put across as the moat against the finance world, very well knowing that finance is the the blood flow of the entire country. You cannot risk, you would rather be late than not reach due to an accident, and that's the theme which the regulator follows, and that's perhaps the last leg of my discussion. And the last slide essentially is a little twist in the story, so hold your horses. There's some excitement on the last slide, right? So let's get started. Well, fintech, if you ask me, is essentially those core players who were already there trying to ideate in the finance industry, but then they realized that going by the organic way of acquiring customers, setting up a brand, giving products which perhaps the peer competitors are already offering, is something which is going to take a lot of time. I mean, IDFC definitely, Dr. Nagendra talked about our MD, Mr. B. Vaidyanathan. He has a clear vision of everything being digital first, right? And when I say digital first, it is just not automation that we are talking about. It is essentially trying to just not cut out the manual part of it, but also to bring in more innovation around how a tech can create more ecosystems that a customer can not think at this point in time, right? Can we create a journey where the banking per se is offered but the bank is not present, right? So you definitely need banking, you definitely need financial services, but why do you need a bank? That's the idea where fintechs start from, right? And we have so many examples in our country, starting with Paytm, listed last year, November 2021, Bharat Pay on its way to get listed, Cash Free lately become a unicorn, so on and so forth. As against a fintech, there is a tech fin. Tech fin essentially is somebody who is originally a technology domain guy who enters into financial sector trying to see how their networking computing skills, big data analysis, their ability to deliver or reach out or scale up business purely on basis of their technological might, uh, enter into financial services, right? And this can be something like a Google or a Facebook. We all know on a WhatsApp you can do similar payments as a Paytm or a Bharat Pay will offer. Google has recently partnered with the Equitas Finance Bank, where they have started offering digital FDs, right? If you frankly ask me, for the Generation Z, right, or the millennials, so to say, they are digital first, and I'm sure none of them have visited a branch, right? And they all have debt funds, they have FDs, etc. Very well knowing that at the end of it, their app will have the analysis, the maturity, the amount, etc., of all those investments they have made, say in a grow, say in a jar. Those kind of apps are the repositories of what your investment activity has been. Right? And lastly, are incumbents, which are essentially the traditional banks, NBFCs. They can be specialized financing outfits like for consumer goods, for heavy equipment, for services, gold loans, etc., etc. Now, quickly we see what are the claims that fintechs today are making, and you may just read through the buzz lines that the challenger fintechs have made in the space of finance. Life doesn't have boundaries, and therefore why should your finance and banking have boundaries? Banking should be anywhere but never at a bank. uh, Best customer journeys are not built and created at the branches. Therefore, forget the products, say hello to experiences. Finance and banking definitely is necessary, but there is a question mark of whether the banks should exist or not, right? So, uh, to start with, that's the theme I would want to build around. The custodials of finance have been disrupted. Finance in its own right has not been disrupted per se by technology. In fact, it has been more beautifully, more easily, more conveniently been served on a platter to the customer, and that's what we will observe, going forward. My daughter has lately picked up Sherlock Holmes, and then while she was mentioning a couple of lines, I found that this was very, very important. It's a big capital mistake to make theories before you have data at hand, right? And unless you have data, you're mandatorily headed towards a bias while making a judgment. And therefore, in this WWF war between fintechs and incumbents, who's going to be the winner? We'd rather look at data first before coming to a conclusion. This is the landscape of the Indian fintech, and I would want all the participants here to spend 10 seconds here. Look, the fintech funding, especially in India, look, I'm not talking about the startup funding. Startup funding is a much bigger space, right? I'm talking about purely those 500, 600 key fintechs who have received funding in in a growing economy like India. India, if I were to tell you, will be ranked perhaps a third or a fourth in the Asia Pac set of countries in terms of attracting FDI into fintech, right? China or Taiwan or Malaysia, Indonesia, they take the largest share, right? And therefore, we are perhaps in the the table there at the third number. And still, if you look at last year, the COVID impacted year, so to say 2020, 2021, where in 2020 only about $2.7 billion had come in. Mind you, this is the year where one Mota Bhai from Bombay had cornered almost $12 billion, right, into the digital or the retail foray that he had done. But still, about a $2.7 billion came into the fintech space. But that said, start 2021, the first quarter itself saw about $3.1 billion coming, right? And the deal in the first quarter itself was half of what was done perhaps in the last 2 years separately. 300, 257, 150 deals in quarter one itself. The year ended, which is calendar year ended itself, 2021 had seen almost a $8 to $9 billion already flowing in. Of course, largest of this money was the October raise of Paytm as well. But that said, I think 2021 in itself, before we close the financial year, will augur very, very well for the fintech. And that shows the kind of interest that the international investor as well as the faith that the Indian consumer is putting onto the fintech world, right? If I were to just go to the market valuations of the fintech unicorns purely, right, and they may not be representative of the total universe that we're talking about in the fintech space, but say the table leaders, Paytm, $25 billion, question mark, $25 billion in November. But as we speak, few investors, I'm sure, are there in the participant space. We are standing at perhaps a $9-10 billion. We will discuss this case going forward in the challenges, right, space where we have seen perhaps a Paytm or a Bharat Pay or a Phone Pay do not have anything which is differentiated from each other very meaningfully, and therefore are we talking about hyped valuations given on not the EBITDA, not the the business value, but on the GMV that is flowing through these companies. And investors have pumped in money, and those were not the smaller guys. Those were the the Warburg Pincuses, the Axel partners, the SEF partners, the the soft banks of the world who know the fintech space not in India but globally, right? So I'm sure they had something back of the envelope calculation when they pumped these largest monies into these companies. But that said, we have a variety. So if you go to Pine Labs, which has disrupted the POS market, Guru, which is a Zerodha led company, they have taken away a lot of brokerage space, or rather the investment advisory space, from the old Motilal Oswals or Edelweisses of the world. And then we have Cred. We all know this credit card linked app that we use, Digit, which became the fastest unicorn in the insurtech space in a matter of 2.5-3 years itself. So many of these. The last the table is very, very interesting, and this in fact builds the narrative of my debate on whether the fintech's gonna win or the incumbent's gonna survive it. If you look at the investment tech, lending, payments, banking infra, these three put together, right, payments, lending, and investment take away almost 65-70% of the business that the fintechs are trying to address. And if you compare, this is exactly what is the core turf of the incumbent banks, NBFCs, gold loan companies, financing companies, which means there is a direct overlap between the business space that the fintechs are trying to address as well as what the banks are trying to say. Now, what exactly the fintechs are doing? Little bit on the last year's highlights. We saw Paytm going public. We saw Policybazaar going public. We had 12 new unicorns in the fintech space, and like I said, year on year, they raised almost $9 billion at the end of calendar year 2021, which was almost a 200% jump year on year. Yeah. What is it that we have in store? I'm going to discuss it in length in the succeeding slides as well. So we'll just skip this from here. At the end of it, what is it that the fintech is attempting to do, right? The challenge that the incumbent right now is facing is you have impatient customers. They're demanding more and more. There are disruptive challengers who are saying that the TAT and the cost of delivering financial products to the end customer is far lesser than what an incumbent bank is charging. Why? Because it is working on a brick and mortar model as 60-70% of their business model, and that costs something. So typically, as I understand, a bank will break even on a certain key tier 1 city branch when it cracks that 2.5 crore revenue mark, which means a branch, unless it delivers a 2.5 crore bottom line, is actually a drag on a bank's revenue, on the bank's profitability, right? So which means your cost and ways and means of delivering to the customer also lag to that extent, right? Then obviously there are large disparate data, and we definitely come across all this problem. While I was at HDFC, I used to get calls from HDFC credit card, from HDFC life insurance, from HDFC Bank itself, asking for whether I would want to open a savings account, whether I would want to take a credit card, so on and so forth. And the journey continues, right? I mean, I'll have to tell the outbound voice sales guy that, look, I am with the bank, kindly check my employee ID, and then he would say, sorry sir. So, and I would receive those calls like alternate days, which means 5 times, 4 times in a week, somebody is wasting those calls, speaking 2 to 3 minutes to me on a customer which already is existing with them. And that's the disparate data that I'm talking about, right? And privacy, less talked the better. Your Aadhaar card and your PAN card is there up for sale, right? At all points in time, you just have to go to a equity broker, near Dalal Street, and you will know that you can apply to IPOs as many times, right, as you want. You just have to buy a few PAN cards and Aadhaar cards, right? So that should be it. So these are the troubles that the incumbents are facing with. Essentially, they are trying to push the product sales strategy, whereas a fintech on the other side will first identify what is the customer problem, right? They are lean, they are nimble, they have capital at their side, at least for next 18 months, 2 years, and they have technology access globally as well as locally. So they will rather first go and identify a Zerodha. When it came into existence, Bangalore, and I have interacted with the the promoters as well as the build out team, the startup team that they had. Very beautiful. Uh, when I went there, they said, look, we do not have a marketing policy. We are just going by word of mouth. And that said, we will still be profitable. And as we know, right, it is just possibly third and fourth year of their true existence, full-fledged existence, and they're already coughing up crores of rupees. Whereas the Motilals, the Edelweisses of the world, the Kotak Securities of the world always believed that if you have to scale up, right, your profitability has to go for a dip. And Zerodha came and disrupted, became the table leader in terms of customer acquisition, in terms of delivering beautiful products, giving top of the chart technology solutions to how a client would want to invest, and just not invest. If he wants to trade, if he wants to do derivatives, if he wants to do equity, currency, multiple pairs, do option strategies, which earlier people were not even aware. Even if they were aware, they were kind of afraid to experiment on the equity markets. Zerodha made it possible. Right? So that's the true way or the difference between how a fintech attempts or how an incumbent attempts. Also, just if you were to look at what is it, what are the 3 4 key activities, core activities, which a bank or a NBFC is doing? Well, they are serving up as a custodial of your investments, of your money. They allow you to do transfer of money from one account to other, one bank to other, one geography to other. They have ability to create assets, which are essentially loans, and cross sell. When I mean cross sell, it means possibly give insurance products to you, wealth products to you, etc. These are the 4 broad categories of what they do. If you see today, right, when I say today, I'm talking about a journey in last 3 years only. Already the fintechs are fulfilling these utilities. If you see this first part of this table, in financial year 2021, already 45% of the payments which are happening, transfers which are happening through the tech apps, the Google Pays, the Phone Pays, the Paytms of the world. Gone are the days that if you want to transfer money from HDFC Bank to a Yes Bank, you would go and open a HDFC app. No, you don't do that. And the journey looks that 75%, I think 75% is far-fetched, but I still think this journey will somewhere stabilize around 60-40 or perhaps 65-35. So two-thirds of the market will be taken away in coming 3-4 years by these fintech guys. Similar is the case with the digital lending, unsecured digital lending. Flipkarts, Amazons. I don't know how many guys know that behind the Flipkart EMI scheme or the Amazon Flipkart scheme, there is essentially a federal bank or a IDFC bank or a HDFC bank standing. So the loan creation doesn't happen at Flipkart's end. It is not on their balance sheet. It is not on their book. It is on a bank's book, and there are co-lending models which are happening in this regard. But this is retail. These are smaller, 10,000, 5,000, 3,000 ticket. Slowly, gradually, we are moving into a foray where the larger SME loans of 10 crores, 15 crores, 25, 50, 100, 500 crore kind of loans will also be lent through such fintech apps, right? Already we see that there's a company in Bangalore called Wind Wealth. I am sure a lot of you guys would know about it, who are essentially giving credit access to startups, to perhaps a low-rated, MSME or a SME, tickets of 10 crores, 50 crores, 100 crores kind of capital market bonds. They essentially take on their book and downsell it to banks, to NBFCs, to retail investors, and that kind of a market deepening has already started. Mind you, Wind Wealth is again, led by Zero Thumb, right? So those integrations we are seeing across. At the end of it, what is it that the fintechs are targeting? What is it that essentially they are eating? Well, they're eating the friction away. In a bank, people who are there with the banks right now know that there is always a fist fight between compliance, between the age old technology that the bank is struggling with, the patchwork that we do time and again. You would have seen HDFCs, you would have seen ICICIs coming now almost every alternate month saying that the net banking will be down, the app will not be working. From this hour to that hour, we have a downtime, and you may not be able to transfer. So please plan your payments, your receivables prior to that. Which means what? That only goes to say that the technology that they are using has already going into oblivion, is becoming obsolete, right? And that's where the fintechs come into picture. Your banking experience, your friction of doing the financial transactions or consuming financial services has to be more fluid, more and more easier, cost effective, etc. And that's what the fintechs are eating into. They're eating into the friction of delivering the financial services to the end consumer, not essentially the bank per se, right? uh, how are the incumbents responding? Well, if you see, in India specifically, I've seen there are broadly four ways a bank or an NBFC has responded. One is people who have thought that, look, the regulator will never allow these fintechs to prosper, right? And they will always have the banks will always hold the upper hand in terms of doing financial services, and people tend to, or organizations tend to vegetate, right? I'm sure they are going to hit the glass ceiling soon. There are second rung banks who are looking at partnership models, something like, say, a federal bank, right? Federal bank is tied up with an entity called Jupiter, which calls itself a digital bank, right? If you open a Swiggy app, you will see there is a slice, there is a Jupiter, right? What are these organizations? A Jupiter will allow you to essentially open a savings bank account in a matter of 4 minutes, operational, right? And you can start doing transactions, and as you do transactions, you accumulate points. Those points can be used anywhere and everywhere, right? So that kind of network they are essentially building, and Federal Bank has tied up with them. A State Bank of Mauritius, I'm going to discuss in detail later, or a SBI, who was recently last year invested into cash free to enhance its payment capabilities, right? Third is acquire a fintech, right? But it's potentially fast, but it's very expensive, culturally very challenging, right? Though those people are techies, and banks typically, and specifically PSU banks, have a different mentality altogether. We understand that. And lastly, there are organizations who would want to incubate fintechs within the organization. People who have done well is something like a Kotak, right? We have a Kotak 811 doing wonderfully well, offering all products that are given by the branch, and in fact more, to the millennials, to the Gen Z, digitally, without any time and energy gone. Right? So broadly, fintechs are trying to bend the space and time what incumbents were taking. Now, this is an interesting slide. I spend a lot of time here and would want your attention. Therefore, I mean, the argument is that, well, has the Kodak moment for the incumbents arrived? Or nearer home, Moser Bayer, if you know, the CD pioneer, never thought that the USBs and the clouds of the world will come and shut the shop once, one sudden quarter, right? So has that moment arrived? I have enlisted all the products that you or me as a consumer would walk into a branch or go to a bank and ask for. Credit card, right? For fintechs, it is just predictive credit access, which means if you spend 20, 30,000 per month on groceries, on small buys, on utility bills, it's predictive credit, right? And can I create a card which will essentially give more features than a usual credit cards of spending and getting points? Yes, say a Unicard or a Slice, who have gone and said, look, I can split the payment that you need to make into a 3-month EMI without interest. A typical HDFC, IDFC, or any other bank, credit card, because of trying to, make that business possible, will charge you maybe a 1%, 2% per month, which tantamounts to a 24%, 30% in terms of annualized interest. Well, there are players in the market, Slice, Unicard, Zeta, Carbon Card, who are bringing new, varieties or new bundled products on your credit card usage itself, right? Overdraft, which is emergency credit access, right? So there are entities like a loan tap, capital float. You just need to have an Aadhaar. You just need to have a CIBIL score, which is good to get a good interest. If at all you don't have a credit CIBIL score, then also they are there to give you at a slightly more risk premium interest level. Right? You talk about savings account, open Jupiter. I mean, open in Jupiter. Let me just give you some facts. A typical HDFC bank or a ICICI or a IDFC, dependent on their branch network, will claim about 12 to 15,000 accounts, or rather say maybe upwards of 15 to 20,000 accounts, savings account being opened from tier 1, tier 2 cities. Right? And here is a Jupiter, which is maybe a 1.5 year of full-fledged activity. They're already doing something like a 5,000, 6,000 accounts per month. HDFC, 20, 21 years of existence. ICICI, 20, 25 years of existence. Lot of distance has already been covered just by the digital disruption, right? Savings accounts. Another interesting, foreign exchange. Now, this is nearer to my heart, so therefore I'll give you a small case in point here. The global market for purely remittances. Remittances means non-capital account or the current account transaction. Capital account is FDI, ECBs, borrowings, dollar bonds, etc. So forget that. No UN aids, etc. Only remittances that we do, travel related, education related, etc. That market is about $800 billion, right? And that market is still growing at a 5% CAGR despite COVID. Okay. The only challenge is intense competition here. And there are early, traditional players like Western Union who have great advantages. They have licenses across major geographies. They have local market knowledge. They have brick and mortar branches who are operating, right? Interfacing physically with the clients, right? But that said, still after COVID, 2 years of COVID also, where their branches were shut almost at 8-9 months in 2020, another 3-4 months in 2021, the digital part of those remittances has only been maybe 5%, maximum 10%. Right? They still do physical interface. And here comes digital native fintechs, something like a Wise, if you have heard, something like a Rippler, if you have heard. They are already claiming $5 billion per monthly volume. And this is when I'm sure half of us will not even know about them. That's the power that the digital scale up can have. The challenge, frankly, in my personal experiences, is doing that first 10% of your activity. The scale up from 10% to next 2x, 3x, 5x is so rapid that essentially we are it is unimaginable. That's the adoption that we're talking about. And therefore, what is happening is, even though people who don't have, the unbanked people are also approached by people like Wise, right? Where they have a tie-up with a certain bank, and as soon as the customer interface happens on a mobile app, right? We all know the access to mobile and internet is greater than, specifically in India, if I were to talk about, rather Asia also, is greater than the number of bank accounts that people will have. So unbanked, janta in India is far more than people who have access to mobile and internet. So that's where the Wise or Ripplers of the world flourish. So, in a nutshell, what I was talking about was that the strength that the banks have is broad existing customer base, broad product sets, stable, time tested, low cost of capital, because they're able to access the fixed deposits and the current account and savings account balances, which fintechs at this point in time are not allowed to regulatorily, right? And they have a regulatory protection also, because of course the banks are under the FEMA as well as the RBI control, right? And revenue source also, which means that the fintech ultimately has to do two things. One, create revenue for itself out of the pie that the incumbent is already creating, and trying to increase the pie by bundling or creating a bigger ecosystem of customers and products, right? That's essentially what they need to do digitally. In India specifically, if you ask me, the biggest disruption happened when in 2016 UPI was launched, right? And till date, we have almost about 5 trillion INR kind of a transaction volume throughput which has gone through the UPI. In fact, if you ask me, when we speak to the global payment players like say a PayU, etc., or even the larger banks, the Goldman Sachs, etc., they stand up and take notice of how the UPI success story has panned out, right? And definitely, this is a pat on the back for ourselves, and the digital vision that the government and the regulator have, that we are right up there in terms of our digital adaptability and throughput, better than the US or the European developed markets, frankly, right? Another joker in the pack, or I will say the key trigger, will be the open banking through the account aggregator regulatory framework, right? Where they are saying, let's have a repository, an entity regulated by say the RBI or a nodal authority, who will have the data, past transactions, banking history, borrowing history of all individuals, entities who have borrowed in past, and new entrants who have never been banked, right? And once that data comes into a repository, all banks, all fintechs who are lending do not have to look at each borrower with the same single benchmark. That means it gives you ability to price each loan or each segment or classification of loan in terms of the borrower's profile. Today, a lot of times the early salary credits or the gig economy lending, sometimes by the incumbent banks and the regulator, are construed as cowboy in nature, right? People say, look, they'll be fly by night because money will go. You don't know when that Ola driver who borrowed 10,000 rupees for a 3 month period is gonna come back, right? Suddenly he'll be just gone in the uh, uh, open space. And you are looking for recovering your money. Where does that money come from, right? We saw this in COVID. A lot of banks, NBFCs, were almost at the verge of going belly up, because the recovery rates had gone down. Right? And these were typically borrowed in the retail asset where it is unsecured, first time borrowers, those kind of people. But this coming in gives you a large set of data to make conscious decisions, right? uh, Three possibly buzzwords that you will hear coming in the future. When I say future, maybe in a year or so. First is neobanks, second will be digital banks, and possibly a hybrid model. Digital banks specifically I will talk about. These are the challenger banks essentially. People who will definitely look at giving you all kinds of services, right, on a mobile app, not necessarily essentially in a format which is of a bank. It can actually be embedded with your Alexa, with your Series of the world, right? So all you need to say is Alexa, uh, please pay X amount of rupees to so and so person, and that should be it. Alexa, please pay my, say, electricity bill. And this is, I'm not saying this is futuristic. This is already under regulatory sandbox of RBI. Lot of these things have already been tested and operated in confined walls of the RBI's permit, right? So this is the next buzzword. In fact, if you see Niti Aayog's latest paper, which was in November 2021, Mr. Amitabh Kant has gone full-fledged in recommending that we should have a full stack licensed digital banks given into the country to take the digital India to the next level. What else? Banking as a service, which means through the API economy, you can embed a bank and banking products into anything and everything, right? And I'm going to speak about it in the slides later in detail. Another important will be something like a BNPL, buy now pay later. Rather, I don't know whether you've heard, Zomato is going to come up with something which is called eat now pay later, right? So it has gone to that granular level that pizza at times might just be on house, right? You'd rather pay it later. So that's where the fintech space is heading towards. Few partnerships which are there in the drawing board. A lot of them have already consummated, whether in fintech space or alternate lending, industry platforms, e-commerce players, digital models, offline partners. All of these have attempted to offer bundled financial products, which earlier the incumbents or the banks or the NBFCs or the gold loan companies were only offering. Now all these are being offered at the platforms that are there in our mobile apps. Now that's where it is heading. Now this is an interesting slide. Look, there are early adopters like a State Bank of Mauritius. Look at this. Core of this is SBM, and then you think about what a bank offers you on an individual side. Say a credit card. They have a tie-up with one card, red carpet. All products that a credit card can offer, they are able to offer digitally in a partnership model. Corporate credit card, if you want to go, Carbon Business Card, Encash, Kodo, multiple this thing. Business banking, entity called Open Bank. Open Bank, what it does, they have entrenched themselves with something like a tally, right? What it gives is, it gives credit history, payment history, cash flow history of a merchant or a small business in a Kochi or in a Garhmukteshwar or perhaps in a Thane, right? All his legitimate entries of paying money, receiving money, etc., all put into a account module, right? And that data is being passed on to the banks. Banks can analyze and go ahead to decide how much they would want to lend, at what price point they would want to lend, right? So things like those. You look at retail loans, Stashfin. Stashfin is there giving unsecured loans at most competitive rate. SBM has tied up. Business loans, you have Ugrow, Lending Card, multiple such players who are going to give you. Trade finance, if you want, there is a Drip Capital who will do invoice financing for you. The trades business which is there, right? So all core banking activity which were earlier only thought to be done through branch, through salespeople, through reaching out to corporates, has been delivered very smoothly at the inset by SBM Bank, by me going as the first adopter of this. But that said, my friends, very important point that I observe, that Fintechs therefore also need incumbents. You need this SBM at the core, right? Which essentially means ultimately you will have to look at the pie that the bank is generating, reduce their costs, and say, look, the EBITDA goes up by this thing. Why don't you share a part of that EBITDA with the fintech, right? So it will be a fallacy if we say that fintech is purely disrupting. No, they are not disrupting. They are frankly filling up the gaps which the incumbents are unable to fill because of their legacy technology, because of their way that the regulator or the banks are cultured to deliver. Product first, push product. If you see, when you go to a branch, the only point that the relationship manager will be talking to is how a ICICI product is better than a HDFC product or a IDFC product. And apps that ways are unintrusive. They will just give you a prompt, right? Those prompts can also be irritating at point in time, but you see that, look, suddenly there is a Navi Finance which is offering a home loan rate of 6.5%. I mean, people are questioning as to what will be the cost of funds. It is akin to what a bank has as a MCLR, right? So they are able to generate that. Why? Because the cost of that legacy is not on their head, right? What has helped, like I mentioned, the regulatory consent has definitely helped, and the Pradhan Mantri Jan Dhan Yojana, the UPIs were or the attempts done by Niti Aayog and the regulatory authorities like RBI were definitely instrumental in pushing the case or the parcel across for these fintechs, right? Coming to the last part of my presentation, and in another 5 minutes, let me just close this. What are the challenges that we need to evaluate, friends? Like I mentioned, fintechs are essentially looking at reducing the TAT and cost, and therefore, whatever the banks save, they want a part of that to be passed on to them as revenue. Therefore, the revenue potential to some extent is limited. I did mention, say, a Paytm, right? $25 billion valuation as on August, right? That was the last valuation they had done before they went into their IPO. And suddenly, in a matter of 2 months, that 25 comes to 16. We are where we are going to close in March, and it's just a matter of 5 to 6 months that we're looking at a $10 billion valuation. Why? The payments business was drawing its meat from the interchange facility, right? The payments, the UPI business that was going through the throughputs, which was going through the Paytm's platform, which is almost 70-80% of their business, right? Remaining 20% will be third-party products, will be cloud services, etc. But 80%, 70% is the UPI throughput that is happening through. And that interchange essentially contributed to almost 40%, 50% of their revenue. And suddenly we have the NPCI coming and the government coming in and saying that the MDR, right, is now only going to be 0. And that disrupts the disruptor itself. And therefore you see that 19,000 crores Paytm had raised since its inception till 2021. Till date, the cash, the costs that they are having is almost 13,000 crores. Clearly indicates that there will always be a cash burn. And added to that, the soft banks or the Ant Financials of the world chose to exit, right, in the stock market as soon as the stock was listed. Of course, there is a holding period, but post that. And therefore, who kind of bears the brunt? The investor, specifically the retail investor. He bought it at an issue price of 2,150, listed, came down to 1,500 rupees, now at what, 550 rupees, right? And that's the specific thing which is a big challenge, which is challenge number 4 here on the next slide. Going to the next challenge, second is a lot of banks, incumbents will cannibalize their own service offerings if they start partnering with the digital native fintechs. Now, it's a catch-22, frankly, right? The customer wouldn't want to come to a branch to take that product. You will have to give it digitally, but then that's a big challenge, right? There is hesitation in the incumbents. Challenge three is high cost of capital and no entry barrier. High cost of capital because neobanks or digital banks, as of now, cannot issue low-cost deposits, right? Regulatorily, so they have to rely on their very expensive equity capital. A low cost deposit will be in the range of what, 7%, 8%, 9%, 10% at max. Equity will never be less than 18, 19, 20%. Right? So that's double of it in terms of cost, right? Makes your profitability scales tilt against your favor. Licensing framework, again a catch-22. If you license, basically you create a moat. If you don't license, then you will have all those unfit and improper entities entering into the market because there is no entry barrier, and then that risks the consumer protection. We were speaking to Mr. G. Padmanabhan, who was a ex-MD of, I think, Union Bank or one of those PSU banks, right now working with the RBI on the fintech space. He quipped, fintechs or digital, fintech or rather digital banks are very interesting animals, right? They make sure that the responsibility of consumer protection squarely lies on the shoulders of the consumer itself. So he said RBI wouldn't allow that, right? And if you don't have entry barrier, again, people will just start replicating business models, and there is no real innovation which is happening. It's basically like a Me Too entering into the digital space. That also is a challenge. And last and least said is the data privacy and security concerns. It's India finally. He also said in that presentation that, gentlemen, we talk about data privacy norms, etc., in Europe, in US, etc. Please take cognizance of the fact that in Italy or in Germany, when there is a traffic light and it blinks red, right, people will go there and stop. In India also, people will go there and stop if there is a traffic policeman standing. That's the difference in culture. So therefore, RBI would rather be late than regret getting into accidents, and therefore a iron fist, right, on giving leeways to fintechs. So finally comes to my last slide, whether fintechs really eating banks or are they increasing the pie? Look, I will make a quick conclusion that will fintechs or tech fins kill the bank? Yes, some of the banks will just go down the drain, but not all of them. People are investing consciously, money, fund, energy, CXOs, CTOs, time and energy in making digital a part of the journey of the incumbent banking system itself. Right? The regulator is also attempting. Will banks on the other side kill some fintechs? That also is true. Absolutely, it's going to happen. Therefore, the truth actually lies somewhere in between. It will be a hybrid model. And if you see globally, you see in US, is a Citibank. No, US is the hotbed of innovation, of tech, right? All the big four, MS, Facebook, Google, and Amazon's come from US. Has Citibank or a JP Morgan or a Morgan Stanley or a Wells Fargo come to their knees? Well, they have not. You go to the European or the UK entities, hotbed of innovation of tech. Have the Credit Suisse, BNP Paribas of the world come to their knees? No, they have not. So why should there be a very different story here in India? Unless we are claiming that in terms of technical innovation, we are some 5x, 6x of what the US does, or in or a UK or a Germany or a France does. Well, that's not the case, frankly, right? So I don't think that fintechs or tech will eat into finance. Definitely, what will eat into is how the tech services get delivered. And gentlemen, therefore comes the last exciting piece of this presentation. I feel this is what the future will be. I've just given an example of the Tata Group. Mahindra's, Reliances of the world are no different. Well, there will come 10th of April or 8th of April, the IPL starts. There will be a launch of the Super Tata app, which is a single app offering multi-category loyalty programs called New Coins. Now, there is a lot of chat about cryptos, about CBDCs, etc. Well, they have generated cash in terms of new coins, but they are not cryptos. They are not digital currencies. They are just reward points. How are these reward points gonna keep a customer inside the Tata's big empire? Well, if you buy, your journey starts by buying, a Tata Safari. You accumulate certain new coins, reward points. You may please go to a 1mg and redeem those points for your pharmacy needs. Go to a big basket, redeem those new coins again for your groceries. As you buy groceries, as you buy pharma products, again you generate new coins, and therefore you can go to a Chroma and buy the next set of headphone that you wanted to buy. You can redeem those points going to a Tata AIA and taking your insurance, taking your car insurance. If at all you have accumulated enough and you want to buy a prime property in Bombay, Tata Housing Society, you may please redeem those points there as well. Now, I feel who's really going to disrupt the finance space is not the fintechs, is not the banks. It is entities like these who will create a castle in which all customer needs are embedded in a single app, and frankly they will deliver banking financial products without ever talking about banks or the friction that people perceive and irritation that people perceive while talking to a bank relationship manager. Now, I think world is very quickly going in this direction, and this should be future of the fintechs. And with this, I uh, put to rest my conclusion. Happy to answer any questions. Thanks so much.
Thank you, Nikunj. Absolutely interesting. I think I think the canvas that you presented, I think it was really interesting and insightful, I would say. Now we have, as you would expect, quite a few questions, and with your permission, I'll take one by one. And I'm taking with your permission. I think there is one gentleman, I think from the banking, so I'm taking his question first, and his name is Rajiv Kumar. Nikunj, and his question is: I'm a senior banker in FTSB, and being a banker, we cannot sit and wait for the Kodak movement. What, in your view, should bankers do ahead to beat this fintech in long-term horizon? Thank you, Rajiv.
Well, Rajiv, I will say that's definitely a very, very critical turning point, right, in the careers of bankers, I will say, and platforms like TSW are definitely, delivering what a banker should now very seriously think about, and which is tech adoption, right? And I can tell you, don't feel, I will say, hesitant in saying that, look, I'm not a tech guy. It doesn't require to be a tech guy. For all I have understood on Google Collab Sheets or going into the the algos which go behind the retail engine of certain NBFCs, is that coding is something which is at the junior level, right? The business ideation is what comes on top of that, and that develops business. Therefore, my only suggestion, or perhaps a quick quip for you and for myself, will be that we will have to quickly upgrade, upskill ourselves in terms of seeing how all those tasks that we were doing manually or delivering manually to the customer, what are the digital ways and means of doing it, and be part of that journey within or outside the bank.
Thank you, Nikunj. I hope that could answer Rajesh. I think this is a question from Sony Patnaik, and her question is, With the rise of more and more finance technologies, the growth of digital fraud also has increased proportionately. In fact, in India, 90% of the digital scam is contributed by the UPI. Thank you, Sony.
I completely agree. In fact, if you see my narrative, the challenges that I have pointed out, and the last one, which was definitely the biggest challenge, which the RBI, in fact, we had interface with two gentlemen, one Mr. Naban, as I mentioned, and another gentleman, Mr. Tanuj, who is heading the fintech space, or rather the white paper that RBI is drafting on fintech, essentially. And they had exactly the same point. They said that RBI can live with the fact that we are behind the developed or peer nations in terms of digital adoption. What it cannot live with is that the seminal, the blood flow finance is in hands of certain miscreants, and at their whims and fancies, RBI or the banks, or essentially the money flow can be brought to a standstill. You cannot risk that, and therefore they are seeing to it that it is security first, than convenience. And I feel, therefore, despite that iron fist control, also, if we are having scams, it definitely presents a case to RBI, and we should therefore not be a party to the complaints and apprehensions that perhaps the tech guys bring in, saying that the regulators are not responding, and there is not enough support, and therefore India is not a great place in terms of digital innovation. I don't concur to that at all, because security comes first.
Absolutely. I think this is a question from Mr. Kumar Chimalakonda, and his question is crypto and NFT, are they a threat to banking? Thank you, Kumar.
So I will excuse myself here. We'll rather have a separate session on this, because if we get into this, another 15 minutes.
Right. Thank you.
But one quick quip on this would be that I think right now there is a great table tennis match at display between SEBI and RBI, where RBI essentially is saying, look, crypto is not a currency; it's a digital asset, right? Therefore, whatever guidelines, so to say, or rules of the game have to be defined by SEBI. Tomorrow, if there is a great scam, nobody should come and axe the RBI governor, or so to say, the officials. And on the other side, SEBI is saying, look, it's definitely a currency. The word says cryptocurrency, isn't it? Therefore, the RBI should put its neck out first. And I think this table tennis match will go for a while, right? The CBDC, which India had to release, had to come in December. They have again pushed it for another 3 to 6 months. I think, and CBDC is much safer straight through application of the crypto per se. But that said, I guess people just want to wait for some more time and see how what are the flip sides of having this before letting go of some control on the currency flow into the economy.
Thank you. I think this is a very simple question, maybe interesting one, Nikunj. And here, this question is from Mr. Tarang, and his question is, what is the difference between a fintech and a neobank?
I will say fintech is an umbrella term. Neobank is essentially one avatar of a customer facing. Rather, if you go to my if you refer my previous slides, a neobank essentially is a technology which is built over and above. It's basically a layer built over and above the banking system, or the infrastructure which is already available. So neobank essentially is nothing but a front ending customer interface offering the same financial product at the background. A very simple example would be that you went to buy a shirt on Amazon, right? And essentially, or rather, through a neobank. Now, uh, the funding which is happening at the background, right? Not a co-lending, but a direct funding by for the EMI option that you have selected is being done by a bank at the back end. But the customer interface that you are having is basically the neo banking technology. This is different as against, say, a digital bank, which will essentially have its own balance sheet. A neobank doesn't have its own balance sheet. It doesn't take FDs or current account, savings account balances to raise liabilities, and on the other side doesn't create direct assets. There is a bank at the background, whereas a digital bank will have the capabilities of the asset liability management that a bank does. So this is the broad difference.
Thank you, Nikunj. And this is a question from Swati Bansal. Her question is, how should traditional banks strategize to survive the fintech revolution? Thank you, Swati.
Very important. I think already the private banks, or so to say, why not, why private banks, SBI for that matter, SBI has already responded by having one YONO, which essentially is the the hybrid model, which is the in-house digital bank kind of a proposition that they have. And in addition, they have started investing into very many fintechs. Cash Free, like I mentioned, was the latest example. They pumped in about, I guess, a smallish amount, though, something like maybe $10 million they had pumped in into that entity, just to start partnering and show that they also have a skin in the game when Cash Free wants to flex its muscles full-fledged in the payment space. So I think the way to survive will be twofold. One, having something which is in-house. Added to that, also learning from what the new age fintechs are doing and trying to mix and match as a product offering to the last mile customer.
And next question is from Mr. Tarang Chandra, and his question is, won't be an omni-channel network be more successful in India?
Well, I think time shall tell. Time shall tell. I mean, things are so dynamic that there is always a risk of spreading yourself too thin, right? So, I mean, we have seen it. I have seen it in a couple of bank journeys who started maybe 4 years, 5 years back. I mean, why banks? I mean, do you think that e-com is when Amazon and Flipkart started in India? No. Amazon and Flipkart came into picture maybe in 2006, 2008 kind of a period. But e-com in its truest nature was happening since last 2000. And maybe all those players were too early in their age in terms of adoption by the customer, right? So whether a omni channel or a narrow bank, either of them will be successful, I personally think time shall tell.
And this is, I think, question to your bank itself. This question is from Mr. Arvind Sundar, and his question is, it's more of a customer support side, technology definitely dominating the banks. And I'm an IDFC customer myself. However, one thing that some banks are adopting is NLP-based cognitive bots. I myself co-own a product solving the entry-level accounting processes. Do you have any data on how well the customer is satisfied with such technology towards such support services? Thank you, Arvind.
I think very important question, but what I would say, the natural language processing adoption at this point in time is still under integration phase, or rather I will say the first phase of their journey. Uh, I I personally think that over a period of time, this is definitely going to be the reality, that all banks, and why banks, all fintech or service providers will essentially move to the NLP chatbot kind of this the customer service. In fact, we did a small project about some months back where we proposed that, and in fact we kind of evidenced and proposed that on the insurance space, on the claim settlement side also, the same concept will hold true, right? Where in fact there was a promoter of a fintech who had a chat with us, and he said, look, what I have seen is that 70 to 80% of the queries that customers put are repetitive, and therefore why have a cost of having a back office person attempting and answering the same question and again. Rather, I will digitize, right, 5 or 6 or 10 FAQs in a program, and then on top of that have a NLP chatbot, and those 70-80% questions will itself get resolved through those FAQ questions, repository itself, right? The dictionary that they have built. For balance 20-30%, we can always have a callback option. So I agree to you. That's where the entire service provider model, whether whether insurance, any kind of this thing shall move to.
Thank you, Nikunj. I think we'll take maybe another two questions with your permission. I think we have already overshot your time. And this is a question from Divya Kumari. And her question is why reverse banking in UPI digital transaction is difficult process than traditional way. Thank you, Divya.
I didn't get the question. Reverse.
Reverse banking in UPI digital transaction is difficult process than traditional way.
I am not a subject expert on that. Reverse banking, I am not sure what
Okay.
exactly that.
Or we'll park it. No problem. No problem. And the last question that we have is from Mr. Mahesh Bangera. And his question is how increasing of NPAs will impact banking industry and what is a better strategy to tackle the same? Thank you, Mahesh. Although outside the FinTech.
No, very important. And in fact, thank you for giving me this opportunity. This account aggregation, the last point, was something which directly addresses this. Look, somewhere there is this perception that the unsecured lending which is happening on the retail assets. In fact, in post the first phase of COVID, you would have seen all banks talking about trying to reduce their exposures to MSMEs, which is essentially the lower spectrum of credit profile, and the retail assets, because there were a lot of delinquencies or delay in repayment in that specific segment, right? Primarily because suddenly the investor feels, or the stock market analysts start feeling that, look, foray or large exposure to this specific segment shows bad credit calls that a bank makes. And the comparison is, of course, this fetches maybe a 14, 15, 16% or NIM of 7, 8% to a bank, because usually those personal loans to the lower spectrum of the credit profile are priced anything between 12% to 16%, right? As against a cost of fund of 6% or 8%. So which means including of your OPEX, you're still making 8 to 9% margin out of it. And therefore the bank's intent, right, to have maybe a 30-40% portfolio of your assets created in retail assets or MSME or SME. Now, this perception of a unconscious, or rather not so data driven call will change as soon as the account aggregator feature comes into the Indian economy. Of course, this is still in the baking stage, but I think soon enough, maybe 6 months down the line, this will be a reality where you'll have fiduciary agents who will be account aggregators, who will be repositories of your individual credit profile or corporate credit profiles of MSMEs, SMEs, everybody. Obviously the larger corporates are already there, in terms of their rating spectrum, right? All Crisils and Cares of the world cover them. But how about the smaller entities who do not have that credit history, say a merchant or a panwala who would want to borrow maybe a 10,000, 20,000, or rather have borrow 5 lakh rupees to increase his raw material storage and sales, etc. That point will get definitely addressed by this account aggregator, and that will help us address this NPA and poor credit calls being taken by PSU or private banks, or so to say any financial lender for that matter, because it is transparently available for everyone to see who you have lent to, what has been his past history. Right? So it is not that under the carpet somebody has pushed in certain details and over and above lent, right, without the public knowing about it. It's available there with the account aggregator for anybody and everybody to see the credit profile before you have lent to that entity. So I think NPA definitely will get addressed by this one joker in the back.
Thank you so much, Nikunj. I really appreciate your time. And it's like I was telling you, I think it's a very, very wide canvas that we're looking at it. And like you rightly said, a lot of things are going to evolve in the months and years to come. But also, I think with several Indian players taking the lead, and the good thing, like you rightly said, is that somewhere we were worried about what happens to the all that we have been hearing about universal banks. I think right, with all the neo banks and the digital banks coming in. I think this in one sense everybody's experienced during their at least the utility part of it. I think everybody's seen during the thanks to the COVID, right? That's what people have seen. But nevertheless, I think this is something we are going to be at least in one or two areas, maybe showcasing our own talent to the rest of the world. I mean, I think that as you get to see about the great success stories of UPI, right? I'm sure in the process, maybe other than being in the rush to unicorn, I think we're also in the rush to have that excellence platform. But thank you so much, Nikunj. It's, I think I know we couldn't appreciate more for the way you have synthesized such a the very wide canvas in just about a few slides. And the best part is, I think Jack Ma's question. I think that's a kind of question. Maybe I don't know if somebody has asked us, or maybe RBI or SEBI kind of thing. But I think it is a very interesting question, which is full of somebody can look at the question as a full of arrogance, or somebody can look at the same question as full of confidence. Either way, but I think that now that we everybody is able to see the results of the outcome, of what that statement is. I think it's a phenomenal one. Thank you so much once again, Nikunj, from all of us, and look forward to having you and hosting you once again. Maybe at maybe at the FinTech 2.0 version, maybe after a few months or maybe next year, sometime like this. Thank you so much, Nikunj,
Thank
from all
you.
of us.
Pleasure is
Thank
all
you.
mine. Thanks.
Thank you
Thanks
so
for
much.
this opportunity. Great questions. Definitely helps me to create in-depth insight about my own thoughts that I've articulated here. Thanks for asking these questions. Thanks so much.
Thank you so much. Thank you all. Thank you so
Please take
much.
care. Bye. Good.